All right, welcome to Talk Tickers. Today, we're going to dig into Bridgeline Digital. That's ticker BLIN. Their latest earnings call was a real head-scratcher, a classic Wall Street puzzle. They put up some good numbers, but the stock, it went the other way. So we're going to unpack exactly why that happened and what it all means.
So here's the big question, right? Bridgeline beats its earnings per share estimates by a whopping 50%. I mean, that's huge. The stock shot up in after-hours trading, but then, poof, it did a complete 180 and closed down the very next day. So what gives? What did the market see that made it change its mind so fast?
Okay, let's just look at the headline numbers. You can see that massive beat on adjusted EPS. Right there, they lost 3 cents a share when the street was expecting them to lose 6. But then, you look at the revenue. Basically flat, and it just squeaked in under the estimate. And right there, that split decision, that's kind of the first clue in this whole story. And this chart, wow, it really shows you that wild ride. As soon as the numbers hit, the stock jumps over 5%. So traders are clearly loving that EPS beat, but fast forward to the end of the next trading day, and not only are those gains gone, but the stock is actually down almost 2.5%. That's the reversal we really need to get our heads around. So to figure out why the stock popped at first, we've got to look at the story management is telling, what we'd call the bull case. They kept using this phrase, a transformative year. And their whole argument is that that flat revenue number is hiding something really positive happening just under the surface. And this, right here, is the absolute heart of their argument. See, management wants you to forget about the total revenue for a second and focus on their core products, specifically their AI-powered HawkSearch suite. That part of the business grew a super healthy 16% over the last year. This, they say, is the real company, the real growth engine.
Now this number, 117%, this is where things get really interesting. For any software company, a net revenue retention rate like this is just fantastic. It basically means their existing customers aren't just sticking around, they're actually spending 17% more than they did a year ago. That's because almost nobody is leaving, churn is under 4%, and they're successfully selling them more services. It's proof that customers are happy.
And look, it's not just that they're holding on to customers. They're getting way better at finding new ones. The whole sales machine seems to be kicking into high gear. They're closing deals in almost half the time. The average new deal is 35% bigger. And get this, the pipeline of potential deals for the new year is 65% larger. These are exactly the kinds of forward-looking signs you want to see.
I mean, you don't even have to take my word for it. The CEO, Ari Khan, he put it really simply on the earnings call. He said customers voted with their pocketbooks. They're renewing, they're expanding, and they're buying more of the new AI stuff. That is a pretty powerful vote of confidence.
And to top it all off, it's not just them saying they're great. They've got some serious outside validation. They got a #1 ranking from the big tech analyst firm Gartner. They've launched 6 new AI products to keep the momentum going. And they're opening up new ways to sell with partnerships like Unilog and getting on the Salesforce AppExchange. It's a really compelling picture, right?
Okay, so that's the bull case, and you got to admit, it sounds pretty good. Now let's pivot to what they're saying about the future, and, more importantly, what the one and only analyst on the call really wanted to talk about.
And this, folks, was probably the single most important thing they said on the call. They basically admitted that this awesome growth in their core products is being held back or dampened by these older legacy products that are losing revenue. But they made a promise. They said that drag should finally be over in fiscal 2026. If that's true, the company's real growth rate could finally pop. And it was interesting. The Q&A, it all came back to this one new thing they disclosed, annual recurring revenue, or ARR. They revealed that those core products we talked about now bring in $8.9 million in predictable subscription-based revenue. Giving investors this number for the first time is a big deal. It provides a much clearer window into the healthy, growing part of the business.
Okay, so if everything's so great, why did the stock end up in the red? Well, that brings us to the other side of the coin, the bear case. This is why all that early excitement just evaporated.
And this right here, this slide just lays it all out, doesn't it? It's the whole debate in a nutshell. The bulls see that 16% core growth, that amazing 117% NRR, and that giant pipeline. But the bears, they just see flat total revenue, they see a company that's still burning through cash, and they see a tiny cash balance. They're weighing the promise of tomorrow against the problems of today.
Yeah, even with all that good news about their core products, the company is still losing money. An adjusted EBITDA loss of about $170,000. Now that's not a huge loss, but the fact is, it's still a loss. They're not profitable yet.
And honestly, for the bears, this might be the only number that matters. Only $1.6 million in the bank. that is not a lot of breathing room. It puts them on a clock. They have to turn that awesome pipeline and all that core growth into actual positive cash flow, and they have to do it soon. Otherwise, they'll need to raise more money, and that could hurt current shareholders.
So, what do we do with all this? You've got this great growth story on one hand and these really serious risks on the other. Let's try to put it all together and give you our forward-looking take on Bridgeline Digital.
So, looking ahead to their next report in February, here are the 3 things you absolutely have to watch for. 1. Did that huge pipeline actually turn into more ARR? We need to see it in the numbers. 2. Cash flow. Are they getting any closer to breaking even? And 3. Is there any proof at all that the drag from those old products is actually starting to go away like they promised? So what's our call on the stock price? Look, right now the market is basically saying, show me the money. The story is great, but it's still just a story. We think the stock is probably going to bounce around without going anywhere significant until the company can deliver the proof, until they show that pipeline is turning into real cash.
And putting it all together, we're landing on a market perform rating for the stock. The potential is definitely there. That AI-driven growth story is compelling, but it's balanced out by some very real near-term risks, mainly that cash burn and the pressure to execute. The upside is there, but so is the downside.
So in the end, it really comes down to this one question for any investor. Do you believe this is a hidden AI gem that's about to have its breakout moment? Or is the risk of them not pulling it off, of not getting to profitability in time, just too high for you right now? That's the bet. And just a quick reminder, of course, this has all been for informational purposes. It's not financial advice. You should always consult with a professional before making any investment decisions.